Hi, this is Marie from Legacy Publishing. In today's video, we are going to explore investing in blue chip companies using option spreads. Chuck, can you tell us about your strategy of investing in blue chip companies using option spreads?
Marie, I initiated option spreads on the blue chip companies listed here. These blue chip companies are less volatile than the market as a whole and are less prone to big price declines due to surprise announcements such as missing earnings. These type of blue chip companies also derive a large share of their revenues and earnings from international sales. Many international economies are growing at a healthy rate, and U.S. companies can participate in this growth by selling their products in these fast-growing economies. Some of the general characteristics of these types of companies would include they typically have solid balance sheets with lots of cash and low debt. They are well established and well positioned in their industries with a long history of earnings and dividend growth. They have an excellent reputation for customer service and goodwill. And these companies look out for their shareholders. These defensive companies can grow earnings even during recessions and slow growth periods. My technical analysis reveals that these blue chip stocks are currently on a buy signal. Here is an example. This price graph for 3M shows that 3M is in a confirmed uptrend as indicated by the stock price trending up and the on-balance volume line trending up, which indicates volume is increasing on days the stock closes up and volume is decreasing on days the stock closes down. This uptrending OBV line indicates the price uptrend can be sustained.
Chuck, how can investors participate in the profit opportunities available for these blue chip companies?
Marie, I have been initiating option spreads on these stocks by purchasing a call option and selling a call option with a higher strike price to establish a debit spread. With debit spreads, your risk is limited to the cost of the spread. My brokerage account transaction record shows examples of recent call option spread trades I made for Coca-Cola, Colgate-Palmolive, Johnson & Johnson, 3M, Procter & Gamble, PepsiCo, Abbott Labs, and Hewlett-Packard. I used the January 2011 LEAPS options, which expire in a little more than a year. The LEAPS options have more time value and provide more profit potential and more downside protection than shorter-term options. Many times I can exit these spread trades before option expiration by closing the spread when it reaches 90% of its profit potential.
Chuck, what is the profit potential with these spread trades going forward?
Marie, let's look at the profit potential for several of these spread trades using the call option spread analysis calculator. This first example displays the profit loss potential for the Colgate-Palmolive spread trade. I bought the Colgate-Palmolive January 70 call at $15.78 and I sold the January 80 call at $9.23. We can see from the analysis that the cost of this spread is $655. The analysis displays the profit potential for this spread trade, assuming various price changes for Colgate-Palmolive stock at option expiration from a 25% increase in price to a 5% decline in price. Now looking at the analysis, we can see that if Colgate-Palmolive stock increases in price at option expiration, a 52% return would be realized before commissions. If the stock remains flat at $84.58, a 52% return would be realized, and a 5% decline in price would also result in a 52% return. Here is another example for PepsiCo. I bought the PepsiCo January 50 call at 12.77 and sold the January 60 call at 6.12. We can see from the analysis that the cost of this spread is $665. If PepsiCo stock increases in price at option expiration, a 50% return would be realized before commissions. If the stock remains flat at 62.29, a 50% return would be realized, and a 5% decline in price would result in a 38% return. Here is one more example for 3M. I bought the 3M January 70 call at 15.58 and sold the January 80 call at 9.13. We can see from the analysis that the cost of this spread is $645. If 3M stock increases in price at option expiration, a 55% return would be realized before commissions. If the stock remains flat at 82.76, a 55% return would be realized, and a 5% decline in price would result in a 33% return. Now you may notice that the purchase and sale prices of these options are odd numbers, like 15.58 for the 3M purchase and 9.13 for the 3M sale. This is a result of using option spread orders to purchase the spread at a specific price. I used a limit order to purchase the 3M spread for 6.45 points, which resulted in a purchase price of 15.58 and a sale price of 9.13 for the limit price of 6.45. So to summarize, the option spread strategy is a great way to earn a 50% return investing in blue chip companies in a flat market. The average return potential for the 8 spread trades I took is 55.8%, making them the ideal trades for a slow growth, low price volatility type of market in 2010. The total cost to trade one contract for the 8 spreads was $5,140 plus commissions, so these trades can be taken in a smaller trading account.
Well, Chuck, it appears that the spread trade strategy for blue chip stocks is a great way to profit in the new year, especially if the stock market trades sideways this year. I hope our viewers were able to gain some valuable insights into option spread trading. I want to thank everyone for viewing, and I am looking forward to our next presentation.